Good morning, everyone. Welcome to Ainsley News, Thursday, the 7th of October. Today, talking supply chain disruptions and slow balancing. With gas shortages and price spikes facing UK drivers over the last month being the latest example, societies are undeniably seeing increased supply chain pressures. In the last 18 months, we've come from expecting international packages to arrive in days to waiting weeks and months for anything we order online to arrive. Individual customers and their manufacturers that produce the products we consume have been majorly affected by supply chain disruptions that are seeing globalization starting to tear at the seams. Globalization has seen a convergence of increased trade, capital flows, and cultural exchange as the world becomes increasingly interconnected. The process has been going on for hundreds of years, but has gone into light speed in the last 50 years, with the internet, mass media, and multinational institutions and corporations growing in prominence. These trends have hit some major speed humps since March 2020. We're going to show a chart in today's news if you want to go online, and you can see that it is starting to tell a different story. Use that chart here if you want to check it out. At this point, globalization has reportedly reached a peak around the late 2000s. In fact, many are claiming snowballization or deglobalization will more accurately reflect the global economy over the coming years, thanks to health fears and government decisions around global trade. Most manufacturing businesses employ a just-in-time model, a production system pioneered by Toyota in the 1950s. The process maximizes efficiency and keeps surplus inventory to a bare minimum. Companies sitting on vast amounts of stock can easily run into cash flow problems and then need to discount, thus eroding their margins. In a globally connected world, this JIT or just-in-time approach has paid dividends for many but has left producers exposed to delays if even one critical part can't be sourced. In particular, for operations sourcing inputs from overseas, the last 18 months has been a major headache. Speaking to CNN, MGA Entertainment CEO Isaac Larian has predicted major shortages of toys in the run-up to Christmas 2021. The shipping container that cost $3,200 last year is now $22,000. Similarly, Jay Foreman, CEO of Basic Fun, has warned you're going to find various times during the holiday season where the store shelves are going to have empty holes in them. Even with national borders, supply shortages have had major knock-on effects. Panic buying has now well and truly entered the vernacular, with waves of panic shopping leaving supermarket shelves intermittently bare throughout the Western world. Prepping has gone from a fringe idea to a mainstream survival strategy. More and more consumers are looking to stock up on long-life products, such as canned food, pasta, and frozen meat, rather than get caught locked at home for 2 weeks with only a box of Weet-Bix and half a litre of milk for sustenance. All of this is leading to higher prices for those who are willing to pay them and a higher cost of living overall. So, where to from here? Recognizing these supply chain vulnerabilities, companies are going to increasingly look to secure products closer to home, even if they need to pay slightly more for the peace of mind that proximity may afford. Rather than just-in-time approaches, producers may stockpile more base materials and inputs to ensure that any short-term disruption won't be able to turn into a long-term one. This increasing demand has already led to increasing commodity prices, from lumber to copper and other commodities as well. Silver, as a major industrial metal critical to the production of solar panels, electronic equipment, and medical supplies, is still waiting to become the beneficiary of these trends. Consider too that, as we shared yesterday, the current inflationary pressures are more supply-based than demand-driven. The above-mentioned pressures should see sticky, not transitory inflation. In our zero-bound interest rate world, that means deeply negative real interest rates, and that too is extremely bullish for both silver and gold. Great news there today. We hope you enjoyed. Remember ainsleyBullion.com.au for all things physical. You can jump online or you can buy in store at our Brisbane and Melbourne office. ainsleywealth.com.au for all things cryptocurrency. Again, you can also visit our stores in Brisbane and Melbourne if you want to buy something over the counter or sell. And check out goldsilverstandard.com for our own crypto built and backed by real gold and silver. Enjoy your Thursday, everybody, and we'll catch you tomorrow for end of week news.